Imagine this. The stock moves exactly in the direction you predicted. You were bullish. The stock goes up, but suddenly, you notice something strange. One option is making a good profit, another option is barely moving, and a third option is losing value. Why does this happen? The answer is one of the most important concepts in options trading. It is called delta, and in this video, I'll explain it in a very simple and practical way. Let's continue our options trading series. Suppose a stock is trading at 1,000 rupees. You expect the stock to move higher. So you are looking at 3 call options. A 950 call, a 1,000 call, and a 1,050 call. The 950 call is ITM, the 1,000 call is ATM, and the 1,050 call is OTM. Now imagine the stock moves from 1,000 rupees to 1,020 rupees. The stock has moved up by 20 rupees. But will all 3 options increase by the same amount? No. This is where delta becomes important. Delta tells us approximately how much an option premium may change when the underlying stock moves by 1 rupee, assuming other factors remain unchanged. Let's keep the numbers simple. Imagine the ITM call has a delta of around 0.7. The ATM call has a delta of around 0.5. And the OTM call has a delta of around 0.3. These are only examples to understand the concept. If the stock moves up by 20 rupees, the ITM option may gain roughly 14 rupees from the delta effect. The ATM option may gain roughly 10 rupees. And the OTM option may gain roughly 6 rupees. Real option prices can behave differently because other factors are also changing. But this example shows you the basic idea. The same stock movement can produce very different results in different options. Now let's look at the OTM option. Many beginners love OTM options because the premium looks cheap. Suppose the stock is at 1,000 rupees. The 1,050 call may cost much less than the 1,000 call. So a beginner may think, this option is cheap. If the stock goes up, I can make a huge profit. But there is a problem. The stock first needs to move significantly higher. And if the stock does not move enough before expiry, the OTM option can lose most or even all of its value. This is why cheap options can sometimes be very risky. Now let's understand ITM options. ITM options already have intrinsic value. Because of this, their premium is generally higher. They can also have a higher delta. That means they may respond more strongly to movements in the underlying stock. But remember, higher premium does not mean guaranteed profit. You can still lose money if the stock moves against you, or if the option loses value because of time decay and other factors. Now what about ATM options? ATM options are close to the current market price. They often have a delta around 0.5, although the actual delta changes depending on the option and market conditions. Because they are close to the current price, ATM options can be quite sensitive to market movements. This is one reason traders pay close attention to ATM strikes. Now let's add one more important factor. Time. Suppose there are only 2 days left before expiry. You buy an OTM call because it is cheap. But the stock moves only slightly. Even though you were right about the direction, the option may still lose value because of time decay. This is one of the biggest lessons in options trading. You can be right about the direction and still lose money. Because options are not only about direction, you also need to consider the strike price, time to expiry, volatility, premium, and delta. So how should a beginner think about ITM, ATM, and OTM? If you want a higher delta and are willing to pay a higher premium, you may consider ITM options. If you want a balance between premium and sensitivity to the underlying price, ATM options can be considered. And if you are looking for a lower premium with higher risk, OTM options may be considered. But these are not rules for guaranteed success. Your strategy, risk tolerance, and market conditions always matter. Let's quickly recap. ITM options generally have higher intrinsic value. ATM options are close to the current market price. OTM options have no intrinsic value at that moment and require a bigger favorable move to become valuable. And delta helps us understand how sensitive an option is to movement in the underlying asset. So the next time you look at an option chain, don't just ask, which option is cheaper? Ask a better question. How much movement am I expecting, and how will this option respond to that movement? That is the mindset that can take you from simply buying options to actually understanding them. If you found this video useful, subscribe to the channel. In part 4, we'll take this one step further and understand one of the biggest option buyer problems. Time decay. Why does an option lose value even when the stock is not moving much? We'll break it down with a simple real-world example. This video is for educational purposes only and is not financial advice.